So in the last part, we looked at support and resistance. And in part two, again, we're looking at analysis, but this time we're looking at trend lines, channels, and ranges. So these are tools that you can place on the chart, but they really give you the same idea of support and resistance. So we're going to relate all this sort of stuff back to what we learned in part one. So if you aren't fully comfortable with that, make sure you go back and check that out again. But if you are, let's get started and begin with what are trend lines. So we know the market moves in waves, right? We know we have this ABC momentum. So here we have a bullish trend of an ABC and another ABC. And of course, let's imagine the trend keeps going on, another ABC. So what's happening here is the market is creating what's known as higher lows. So when the market makes this upwards zigzaggy movement, that's a low, that's also a low, but it's higher than the previous one. So this is let's say the first low, then this is a low that is higher than the previous one, and another higher low. So the market is creating these downwards corrections, but it's getting up higher and higher each time. Because of course, if the market made a lower low, let's say that this low here broke below this one, that would actually be changing the direction of the trend. Because then you could have a huge A to the downside, potential bearish ABC. So the market's going up, it's a bullish trend, making higher lows. You can connect the lows in this uptrend and create a trend line. So essentially what it's doing is giving you an overall visualization of the direction of that trend, and also possibly giving you an area of support where the market is bouncing from as it moves upwards, and then potentially, remember back to the last idea of if support breaks, it could form resistance, that sort of thing too. So it's almost like a level of support, but slanting upwards, following the lows of that trend. And really it's best when you use it just for visualization. So we're kind of looking at the market, we can see the direction of the trend, and this line is kind of allowing us to visualize the upwards bullish trend and those higher lows. So markets can give you ascending and descending trend lines based on whether it's a bullish or bearish trend. So what we just looked at there was an ascending trend line because it's of course ascending upwards. Whereas if we had a downwards market, so here's a downwards A, B, and C, the beginning of a bearish trend here. Another A, of course, this now becomes A, B, and C, A, B, and C. So it's clearly a downwards moving trend. Therefore, we can connect the lower highs, because last time we were looking at higher lows, now we're looking at lower highs. Because as the market makes these corrections to the downside, well, it's kind of correcting to the upside as it's moving down, it's forming these high points, but they're lower than each other. Otherwise, again, if this was higher than this one, it would actually reverse the trend and be a bullish ABC, then we wouldn't really be looking at descending trend lines. So it's a bearish trend, these are the lower highs, and we can connect these lower highs together in a downtrend to give us a downwards descending trend line. So again, it allows us to see the structure, to visualize that structure of the downwards trend, and also potentially give us it's kind of a proactive level of resistance where the market, there's not an exact price because it's obviously moving downwards through the chart, but if the price returns to that line, it could give us some resistance because it has before when you connect those lower highs together. So therefore we have the two trend lines there, the bullish trend giving us an ascending trend line and a bearish trend giving us a descending trend line. So let's have a look at these on the charts. Now here is an example of an ascending trend line. So you do have a bullish chart. You can see that the lows of this higher low, higher low, higher low. So even though the trend is going upwards, you still have to make those pullbacks, but there's not really any low that's lower than the previous one by any substantial margin. So here you got an A, roughly a B and a C. That C becomes A, B, and C. And although this one does retrace all the way back down to the previous low, this now acts as support. So remember, back to part one where you have the horizontal level. So now you have sort of two levels because you have, as the market comes down here, you've got the potential trend line support because you've connected the lowest points. If we go back to the beginning, you've connected the initial low with this low. So you kind of draw the line to the next low that projects the line outwards, therefore giving you the potential support level later. And on top of that, you also have the actual horizontal support made by this low as well, and also the previous high on the first leg up. So as we come back down, you're entering that level of what's called confluence. So confluence is simply when you have multiple things lining up, so multiple tools or analysis styles lining up together and giving you that confluence. So there we have another little bounce to the upside. So you have found support from the horizontal line and also from the trend line. So there's a higher low, and potentially another higher low ready for the next leg to the upside. Of course, if you broke down below, it may be a different story, but there is your ascending trend line, giving you that support, allowing you to visualize the structure of the upwards trend. So let's now move on. Let's have a look at a descending trend line. So here we have a downwards bearish chart. So we can see here that we have an A, a B, and a C roughly. There are smaller waves in between, but that's like the larger wave. You then come back very, very sharply for a really quick, pullback, but very, very strong, and then move away again, equally as strong, if not stronger. So we now have these lower highs, because remember last time we had higher lows. This is a downtrend, it's a bearish trend. So we have lower highs. That's the first one, there's the second one. So you would connect that line together with the first and the second, projects outwards, gives you the rough area. Again, it's never going to be an exact area, but a rough area where that third lower high may be. And if the market breaks up through, something we'll look at very soon, you could then break through that resistance and form support there. So always think of these trend lines, like I said to begin with, as almost like horizontal levels, but slanted, up or down, ascending or descending. So there's your trend line, and of course, highs of the bearish trend, allowing you to visualize that structure and giving you that descending trend line. So these can act also as support and resistance instead of just visualization. So if you imagine you have an upwards trend, you've got a bullish ABC, and another one here, so you can now connect those two lows together, which would give you the ascending trend line, so connecting those lows together. Now what happens if you have a massive bearish movement? So there are higher lows, and let's say this happens. So what now may be the case is you had the bullish ABCs, now this could be a bearish A, because you've just broken and closed below that higher low. So it's like the last stand for that bullish trend. You've also broken straight through the trend line. Well, they can also act, again, just can, because not always, but they can act as resistance. So if the market starts to rally back again, it could just be forming a lower high. So a B pullback before a C continuation. And roughly in the area of that trend line, if price tends to meet it, or price does meet it, it can sometimes act as resistance. So if you slanted that image like, 30 odd degrees to the right, then it would just be looking like a horizontal level. So try and think of it in the same sort of way, just like slightly less important, slightly less strong than a horizontal level would be. So therefore we have that lower high potentially, but it is on this example, making that C momentum leg to the downside in the bearish ABC. So they can just act as those sort of rough support and resistance lines, and when they break through, just be wary that they can act as the flipped level on the other side. So let's have a look at a chart example of this. So we can see here that you have these previous higher lows, connecting those lows together, kind of pushing the line into the stratosphere. It's quite far to the right here, but pushing it outwards. You can see that this actually gives us, when the market does pull back, roughly where that high is. And if you look at that high and look left, notice there's actually a horizontal level there too. Again, so you've got a horizontal level acting in the same place as this time a broken and retested trend line, whereas previously we looked at a horizontal level acting in place with a trend line being tested on the same side. So just be aware that, if you do have this double confluence, it can be even stronger. So a very, very strong move to the upside, and the market stops roughly where that trend line is and where the horizontal level is also. So therefore, if you extend it outwards, it can give you that sort of that resistance in the future. And if this was flipped around, of course, it would be a descending trend line, broken through as resistance, but not acting as resistance, and then potentially acting as support as it comes down to retest. So let's move on from trend lines and look at channels. And when I say move on from trend lines, really it's just almost the same thing, and you'll see what I mean very soon. So here we have an ABC, a downwards movement, and if you notice the highs and lows, so the lower highs and the lower lows of this downtrend, they're kind of parallel. So if you drew a trend line, let's first draw a descending trend line, connecting these lower highs together. So drawing that descending trend line. If you copy and pasted that trend line and then just dragged it lower, you'd find that the lows roughly connect together also. So this time, instead of throwing the ball at the floor, imagine you're throwing a ball into like a tube, and it's just bouncing up and down the tube, but the tube is pointing downwards. So it's like the price is being capped on the high and the low by this channel. So it's still a trend line. We still think of it in exactly the same way as before. You have your resistance to the upside, your support to the downside, but instead of just having one line, now we have two. So that's all the channel is really. It's just it's a trend line times two, where it's keeping the price almost kind of like within that tunnel as it moves downwards. So this would of course be a descending channel. You could have an ascending channel as well, both exactly the same thing with the same characteristics as a trend line would have before. So if this were to change direction of the trend and starts to rally to the upside, breaking through the previous high, breaking through the trend line, well, you just use the same ideas as we looked at before. And of course, if it breaks really far to the downside, it eventually does have to come back up to retest again. So similar ideas really as the trend line, but now times two. So let's have a look at the chart. Now you can see here that the highs are not exactly the same. That's why I say it's always just a rough area, but they are capped by that upper trend line boundary. If you then copy and paste that and make it a parallel line, you also roughly get the lows as well. So those are our lows down here, and here are our highs. So we have that downwards kind of tunnel that's being bounced up and down in between. And in the middle of that, if you drew another line in the center, you do have a lot of sort of like quite rough, volatile price action. But as it reaches those extreme high points, you do find that selling and buying coming into the market. So if you were to really rally hard to the upside, then you may find that the descending trend line to the upside gets broken, could be acting as support in the future, or the previous high could act as support. But you know that may occur, you can watch out for that sort of thing. So just two parallel lines roughly acting there, helping you to visualize that trend. Let's move on now to ranges. So think of what we just did. So you'll see as we go through a lot of these things that they relate to each other very, very closely. So think of what we just looked at, and now turn that on its side horizontally, and we then get a range. So consolidation, as we know from chapter 1, is when the market doesn't really have a direction, it's just going sideways. So it may look as if it is. When you look at this movement here, you might think, right, this is the C, it's going to break below the low, make a new one, find some support. Now what you're thinking, right, the market's made a support zone. Maybe it's going to bounce higher from here. Comes to the previous high, bounces back down again. Now it's kind of stuck in between two levels, back up again, back down again. So clearly the market's not really moving in any particular direction. It's finding support and resistance at the high and low, but it's finding no overall momentum on this time frame. So this is now an area of highs, which is now resistance, and an area of lows, which is now support. So it's a consolidation range. And you can simply box that range off, as in you can place a box on the chart or two lines above and below. And it's almost like a channel, but it's now just horizontal. So it's like a horizontal tunnel that you're, again, throwing the ball down and it's just bouncing up and down as it goes through, but not really changing. It's not breaking through either of those boundaries. So you can imagine if it breaks down through the lower boundary, then think back to what we looked at the very beginning, what could happen? If it's support, that could then break, come back to and become resistance. If it breaks above the top side, that resistance could break through and become support. So it's all the same ideas, but just in different contexts. So therefore you can mark out that range, you know it's consolidation, and you can take action on either side of that range. So lastly, looking at that example on the chart, it's a very broad range. So you can see if you look in between, there's lots of kind of ABCs and waves and messiness, but overall, it's really not moving in any particular direction. Every time it tries to break above the high, it whips straight back again. When it tries to break below the lows, you can see on the final candlestick on the right, straight back up again. So let's look at the lows here, let's look at the highs. You have a rough area of resistance and a rough area of support. Therefore, you're being given that range of price, that consolidation of price. So if it does continue in a bearish direction, let's say the next candle after the one on the extreme right breaks straight down through, then that support level of the range could then act as resistance. And if it rallies all the way to the top, you have resistance. It could bounce away from that and then it can go down again and start to return back to the low of the range. And you can obviously look for clues in the price action, things that we'll look through later, that may give you ideas as to which direction that's going to go in. So those are our trend lines, our channels, our ranges, which are simply variations of horizontal support and resistance. And when you can find these that are in the same place as a horizontal level, obviously with the range it's always the same, then that's a confluence. It's two things put together. So that's all for this part. I will catch you on the next part and see you there.